What's up, everyone? My name is Ale. Welcome back to my world of stocks, and welcome back to this four-part mini series where I rank every single dividend king stock in the market and let you guys know if I think any of them are worth investing in. Today is going to be part 2, so we'll be running through stocks number 11 through number 20. Now, if you haven't seen part 1, make sure you go down into the description. I'll leave a link for part 1. It'll explain what this series is and how it's structured and everything that's going on. But if you've already seen part 1, then no need to do that. Let's go ahead and jump into this. We've got a lot of stocks to cover. By the way, I hope you guys are enjoying this little mini series. Hit the like button if you are. Really helps the channel survive and grow. And let me know down below if there's any other kind of little mini series that you'd like me to do in the future. But with that said, let's jump into stock number 11. Okay, so we're back at it here. Like I said, stock number 11. And for this one, we've got Cisco, ticker symbol SYY, who operates primarily in the food industry as a wholesale provider of various food and kitchen related products to restaurants, hospitals, schools, and various other entities. So, for example, when you're eating at a restaurant, you might be eating ingredients that were actually supplied by Cisco. It's a business that is not likely to ever go away because these different businesses will always need food supplies and those related products. But because so many of them these businesses were forced to close down during the pandemic, especially in places like California, where nearly a third of all restaurants went completely out of business. Cisco's revenue and profits also took a big hit, with revenues plunging by 12% in 2020 and another 3% in 2021. Now, they are expected to recover largely this year and the next, but over the long term, this is typically a low single digit growth business. And when you look at the stock, it's already largely recovered back up to a record high, which isn't all that appealing to anyone looking for a great deal, especially with the risk of another recession or if lockdowns ever come back from another virus. I just think that the business is too vulnerable to macroeconomic conditions. Now, the valuation is pretty good. I would say PG ratio below 1. That's always good. You always want to see that. And the dividend of around 2% with 51 years of growth, that also sweetens the deal. But that dividend is not likely to get a whole lot larger with a payout ratio of already 80%. That's very high. It's really just a middle of the road type of dividend stock for me. It's not bad, but there's definitely better options out there. So I'm going to put them in the average category for now. Okay, now moving on to stock number 12, we've got Altria, ticker symbol MO, who is famous for selling cigarettes and other various smoking and tobacco and even wine related products, primarily across the United States. One of their most popular brands that you've probably heard of yourself is Marlboro. However, with the decline in popularity of cigarettes, you guys have all probably noticed that the business of Altria has been shrinking over the years. Now, to be fair, they've been trying to move away from just being known as a cigarette, primarily cigarette company, by investing in companies like Anheuser-Busch for beer exposure. They've invested in Kronos for MJ exposure, and even Juul for vaping exposure. But overall, it's a struggling business that has seen its employee count drop from over 8,000 in 2018 to just about 6,000 last year. And while sales have been steady over the years, profits have mostly been in decline. Some of that can be overlooked just for the gigantic dividend of over 6% yield with 52 years of growth supporting it, but the payout ratio is already high, and the stock itself is down over 20% in the past 5 years, despite currently trading at a 52-week high. So, with little to no growth from the business, the dividend, or even the stock itself, I just can't really see why anyone would want to own this unless you have a specific purpose, like maybe swing trading it, or for the high dividend yield, or because you think that they're a really good turnaround play, something like that. But for me personally, I just feel that it's more of a dividend trap than anything else. It might entice investors because of the dividend, but then you end up with something that is really not that good of a long-term investment. So for me, I'm going to rank them as really bad. I'm tempted to put them at below average, but I think just for me personally, I really think that this is a stock that I will never own in the future because I just really don't see any kind of a bright future with them. So I want to put them in the lowest category. Now, next up, we've got HB Fuller Company, ticker symbol FUL, at stock number 13, who primarily sells adhesives, sealants, and other specialty chemical products related to healthcare, hygiene, engineering, construction, and even packaging for things like food products or tapes or all kinds of different things. And it's basically like I would say it's a huge glue and sealant and bonding type of company if you try to describe what it is. And I actually think that that's pretty cool. It's one of those things that we don't normally question where it comes from in our daily life, but some company out there has to provide these glue-like materials for other various products and packagings and things like that. And so far, that niche kind of market type of play has resulted in a business that is not likely to ever go away or stop being needed, but it's also a very low growth one, unfortunately. In fact, in 2019 and 2020, they actually saw a decline in their sales in both of those years, and their profits typically hover around the same kind of steady amount every year. But I would say overall, they are pretty heavily reliant on the strength of the economy because you really need companies to perform well and sell more products during a booming economy so that they need HB for their glue like materials and those chemicals and all that kind of stuff. So while revenue is expected to climb by a large 15% this year and another 5% next year, with EPS growth of close to 20% average per year over the next 5 years, it's pretty darn good. My issues with the stock though is that number one, I think analysts are too optimistic and they're estimating way too high for their business in the coming years, which could lead to them missing targets, especially if the economy struggles. I think that would really tank this stock, and that's a concern that I do have when looking at the macro economy going forward. And even in their most recent dip, that leaves them around the midpoint of their 52-week range, the dividend yield is still tiny at only 1%, with a super low growth rate of less than 4%. So, as a dividend stock in particular, I just think that it's too boring. It's pretty slow moving to give any kind of huge value to the investor. And for that reason, I'm going to have to rank them as below average. That yield is just way too low. And I don't see huge gains coming from the stock either when considering the macroeconomy that we have right now and going into the kind of near to mid term. Over the long term might do a little better, but as of right now, I just don't think it's that great of a stock. Okay, moving on to stock number 14 though, we've got ABM Industries, ticker symbol ABM, who is pretty boring to be honest. They're just a facilities manager. So think of office buildings or schools or even airports. These are all areas where ABM comes in and they clean and organize and manage and provide all kinds of different services so that everything keeps running smoothly within the facilities. I'm sure that's a service that will always be needed, but their financials are mediocre at best, as even their cleaning services were not in higher demand during the pandemic because the lockdowns really offset that. These facilities and businesses, they were kind of closed down, so they didn't really need ABM services, and that caused them to really miss an opportunity there to benefit from the global craze of cleanliness and the pandemic and all that kind of fear and all that kind of stuff. In fact, I would argue that the world is actually evolving to a future that will need ABM services even less because of how many businesses and schools are now adopting remote work and remote learning. You're not going to hire ABM to come to your house and do those services. So I just really doubt that you're going to see any kind of explosive growth from this one. Even the stock price itself has already recovered from the pandemic with over 30% gains this year, and they're now trading at an all-time high with a dividend yield of less than 1.5% and a terrible growth rate of less than 3%. Honestly, I can tell you right now that I will never be owning this stock, so I'm gonna have to put them in the really bad ranking for me because it's really one that I'm just not interested in it at all, to be honest. Okay, we're at stock number 15 now, and for that one, we've got California Water Service Group, ticker symbol CWT, who is actually pretty interesting because if you know anything about California, it's that they really suck at water management and they're constantly going through like droughts and all kinds of other issues where they need more and more water and they typically waste it. They're just really bad at their water management, so they always need more and more. So in CWT's case, they're a utility that produces, purchases, stores, treats, tests, and even sells water throughout California, Washington, New Mexico, and Hawaii. And that's just a business that I think is in very high demand right now, and it'll likely be in the future too. And that's really led to strong financials for them over the years. And even during the 2020 recession, where sales actually grew by a whopping 11%. And even when they very slightly corrected back down in 2021, that was just a less than 1% drop, their profits actually went up. And so it wasn't even a bad year for them, and sales are still growing even moving forward from here as well. So overall, I feel that this is a pretty solid stock because even with a recent dip of almost 25%, it's still up about 50% over the past 5 years. Plus, you get a nice little dividend of almost 2% with 54 years of growth. Granted, the growth rate is pretty small and you're not likely to see giant gains from this stock. I wouldn't really be expecting that, but I think long term, it's at the very least a reliable utility that is somewhat recession proof because people are always going to need water even during economic downturns. And even though I don't plan to buy the stock myself, I'm going to be generous here. I'm just going to go ahead and put them in the above average ranking because when I look at the other stocks that we've gone through and I kind of know what's coming up in this video, uh, I think this one is above average, to be honest. All right, now for stock number 16, we've actually got the first real estate investment trust, and that is Federal Realty Investment Trust, ticker symbol FRT, who, like any other REIT, they own various properties with a mix of malls and shopping centers and even some neighborhood apartments they've got thrown in there as well. Now, they typically hand select a property, they go in, they fix it up as much as possible, and then they rent it out for higher prices to make a profit over time. So, I would say that as of right now, the formula has worked relatively well for them over the years, but the 2020 lockdowns, that really hit them very hard as sales and profits plummeted for, I would say, most rates, just kind of across the board in general. And while sales are now recovering again with around 5% growth expected this year and the next, the stock is still trading slightly lower than it was 5 years ago. So, not very good. On one hand, you could argue that we're looking at a suppressed stock here that is worth picking up for the nice 3.4% dividend that has been grown for 53 years in a row, and maybe it's a good turnaround play even for the stock. But on the other hand, the stock might be a slow mover in a brick and mortar retail environment that is moving more and more towards an online future, and even the nice dividend itself, it's overextended on the payout ratio with a tiny growth rate of only 2%. So gains are likely going to be limited for you over the long term, no matter kind of how you look at this stock. It's going to have to be a below average for me. I just think that there's many other better options out there in the market that you're not going to get as big of a headache with owning. Okay, now that brings us to stock number 17. And for that, we've got Stepan Company, ticker symbol SCL, who is basically just a chemical specialist that develops and sells various types of chemicals that are used for different purposes like agriculture, industrial, construction, all kinds of cleaning, personal care. The list really goes on. And so far, they've formulated close to 400 different chemicals with over 650 different products across more than 20 different markets. This isn't really an area that excites me that much personally, as I don't typically research or even use many chemicals myself. I try to avoid those as much as possible. So it's probably a stock that I would never purchase, but just looking at their financials, the stock and the dividend, it's all kind of middle of the road, I would say. I mean, sales dropped in both 2019 and 2020, but then they recovered after that and are now growing by single digit percentages per year. The stock is trading at a 52-week low, but despite that dip, the dividend is still barely yielding 1.3%. So it's not that great of a value when you look at the dividend being so low. Now, the dividend does actually have some pretty nice growth metrics on it, like the growth rate, the payout ratio, and of course the growth history. So I'll be generous with this one. I still think it's very middle of the road. As a dividend king stock, I'm going to rank them as average. It's not something that I think is really worth picking up, but I could understand why maybe some other people would own it. All right, now we're now breaking into the final three stocks of this part two video. And coming in at number 18, we've got a pretty interesting name here in SJW Group, ticker symbol SJW. That's unfortunate. But believe it or not, this is actually a water utilities company, so really nothing to do with that term that you're probably familiar with. It actually stands for San Jose Water, which is where they were founded. Anyway, they're more of a holding company that owns subsidiaries related to water utilities and some real estate in a few different parts of the country, a couple other things. But so far, financials have been strong for them over the years, with a large jump in sales and profits past 2020, even through the recession. And they're still expected to pop by 12% this year and another 3% next year as well. The stock itself can be a little volatile, but if you look at the range, it actually doesn't move very much and is only up about 25% in the past 5 years. The dividend is a little small at a 2.3% yield, and while it does have a double-digit growth rate, I think that's kind of offset a bit by the high payout ratio. Overall, I would say that this one is also kind of middle of the road. So I'm going to give it an average ranking. The dividend isn't really exciting enough to attract me into buying the stock, and the business, it does look good and it might be worth owning for some people in certain cases, but I don't know. I think overall there's better options out there. Okay, moving on to the final two stocks. We've got actually we've got some pretty interesting ones here, some pretty interesting dividend kings left that I frequently get asked about by viewers. And coming in at number 19, that's going to be Stanley Black& and Decker, ticker symbol SWK, who you probably recognize for the various tools that they sell. In fact, they claim to be the largest tool and storage company in the entire world, with super popular brands like Stanley, DeWalt, Craftsman, Black& Decker, and more. And this popularity has really led to a lot of success for them, even through the 2020 recession, as people were staying home due to the lockdowns and working on home improvement projects. In many cases, they were using products from Stanley, which helped their sales tick up slightly by 1%. And coming off of that, sales exploded in both 2021 and 2022 before being projected to correct back down to mid single digit growth in 2023. Now, the stock itself, it looks a bit suppressed considering the strong performance, as they have now fallen back down to below pre-pandemic levels, as if all of that explosive growth has not even happened, and that's leaving the stock about flat over the past 5 years. This also leaves their dividend yield above 2% with 53 years of growth and a super low payout ratio, so it's very unlikely to ever see that dividend disappear, at least not anytime soon. It's a little too small of a dividend to really attract me in a big way, and I'd like to do a little more research into their business and their competitors before I go ahead and buy the stock. But I can tell you right now that just based on everything we've seen today, this one is definitely above average. I would even consider maybe putting it into the really good category, but I feel like I should be buying the stock if I put it into that category, which I'm not buying it yet. But it's a stock that definitely interests me, so I'm putting it at above average. That's the ranking I'm giving it for now. Okay, and finally, we've got stock number 20. We've got Target here, ticker symbol TGT. It's a very popular stock. I always get asked about it. Now, you've probably shopped at Target yourself, I'm sure. If you haven't, I don't know, you might be living under a rock. This is a very popular retail company. In fact, they're the 7th largest overall retailer in America, the 6th largest in e-commerce. And I'll be honest with you guys, I love shopping at Target myself, and I've always thought that the stock was pretty good just because financials, they're always strong with over $100 billion in sales last year alone, and they're still managing to grow by low to mid single digit percentages, even coming off of the explosive growth that they saw during the lockdowns, where everyone was spending money at big retailers that were allowed to stay open, while, let's be honest here, unfortunately smaller shops, those were getting hurt and were, in many cases forced into bankruptcy because they weren't allowed to stay open, while these big giant retailers were allowed to basically run unchecked. Anyway, that's maybe a topic for another day. When looking at just the stock, let's be unbiased here, just looking at the stock. Now, I would say it's always been a stock that interested me, but there are three primary reasons why I don't think I will ever buy this stock myself. Reason number one, Amazon is the dominant player in the market, and I only see them getting larger over time, which I already own Amazon stock myself, so that gives me plenty of exposure to retail, as they are my second largest holding. Reason number two, the dividend is tiny at less than 1.5%. Yes, it's been grown for over 5 decades in a row, but it's still too low right now to really attract me just for the dividend alone. And that brings me to reason number three, and that's that the reason why the dividend yield is so small is because the stock itself is up almost 350% over the past 5 years, which keeps that yield low. At this point, I just feel like I completely missed the boat on Target. I'd rather wait to see if it crashes before I decide to buy into it. It would have been a good investment. I should have bought it, hindsight is 2020. I should have bought it back then. But as of now, I feel like I missed the boat. I'm going to have to give it an average ranking because I just really don't see myself buying Target, even though I actually do kind of like them. But I still think that there are better options out there considering the current price for the stock. Okay, that does it for the video, guys. So to summarize here, we've got Zero stocks in the really good category, unfortunately. Nothing that really stood out like in a gigantic way. We got two stocks in the above average category with California Water Service and Stanley Black & Decker. We got four in the average category. That was with Cisco, Stepan Company, SJW Group, and Target. We got two in the below average category with HB Fuller and Federal Realty Investment Trust. And then we got two in the really bad category with Altria and ABM Industries. So overall, I would say that this was not a very good batch of stocks here. I'm a little disappointed here with part two. I think in part one, we definitely had some better options there. But let me know if you agree or disagree with that. If I had to choose one stock out of all the ones we talked about in today's video to invest in, it would definitely be Stanley Black & Decker. That's my favorite one out of all the ones. Really the only one that I'm pretty interested in myself. I'm actually going to research them a little more, and who knows, maybe I'll end up investing in them in the future. But the rest of the list just really wasn't that appealing to me. So let me know what you guys think. Are there any stocks on here that you like? And stay tuned for part three, because there's actually some pretty good ones coming up in part three that I think you guys are going to want to hear about. So make sure you watch that one. That'll be the next video coming up. Hope you're enjoying the series. Hope you're all doing well out there. I will catch you in the next video. Take care. Bye-bye.